This is the first in a series of lectures on Islamic finance. And we decided to do this actually after I had a conversation with Iqbal last year. And for years, many of our students have been saying, what are you doing in Islamic finance? And so far, we haven't done that much. But Islamic finance is this hugely important investment industry. It's a $1.3 trillion investment industry. But there are many of us out there, including myself, that don't know very much about how it works. And so the idea of this series that we put together with Iqbal's help, and I'll introduce Iqbal in a second, is to educate us all about how Islamic finance works, where it's come from, how it's evolved, and how transactions are structured. So the first lecture we have today is from Iqbal. As I say, I'll introduce him to you in a second. And then we've got another 5 lectures. We've got 3 lectures from partners at City law firms who will be explaining concepts and structures in Islamic finance. We've got a lecture from Anne Pettigrew, who is an outsider to Islamic finance. It's going to talk more generally about ethics, interest, and finance. And then we have a lecture from a Sharia scholar at the end of this series. And then finally, there's going to be a House of Commons reception with a speaker. We've still got to finalise that final speaker. And the House of Commons reception, hopefully many of you who are here today, if you stay with us through this series, will be able to come along to as well, if you'd like to come along to. So the first of these lectures is from Iqbal Khan. Now, Iqbal is a major figure in Islamic finance. He was involved in setting up HSBC's Islamic finance business and is now the Chief Executive Officer of Fajr Capital, based in Dubai, who are one of the major Islamic finance investment firms. There are many things I could tell you about Iqbal. He's on the board of directors of the bank Islam Brunei Dar es Salaam. He has multiple accolades for his work in Islamic finance, perhaps most importantly, the recognition given to him by the government of Malaysia recently for his work on Islamic finance. Iqbal is going to talk to us, he's going to provide us with the context about Islamic finance. And he's going to tell us about the history and evolution of the Islamic finance industry. So I'll hand over to you, Iqbal. I think you're going to talk for about 30 minutes or so. I asked Iqbal whether he'd be happy for us to interrupt him during the talk to ask him questions, and he said he's very happy to do so because this is really about educating us all about how this works. So I think all of us should feel very free at any point just to put our hands up and ask Iqbal to explain any questions that we might have. So Iqbal, over to you.
Thank you very much, David. Let me begin with the Islamic greeting of Assalamu alaikum wa rahmatullahi wa barakatuhu. Peace be upon you all. It is such a pleasure to be here at LSE. And I first time came...
Can I just switch off the computer behind you if I may, because that would be just slightly distracting.
I first time came to speak at LSE in 1998 when we did a careers fair to hire people for HSBC Amana. And we hired 4 people and all of them ended up becoming managing directors at HSBC today. So LSE, I am really grateful and honored. Since then I have spoken 3 other times. One, we do this event at LSE called the Harvard LSE annual event here, in which there is a public lecture. What I wanted to do today was to set the context of Islamic finance in the sense that the concept, the history, the evolution, and quickly take a stock trade as to where the industry is. And then some of the challenges. And as David mentioned, please feel free to ask any question, because I don't grade your work or as if you are students, or I don't promote you if you work in any organization. I'm here to talk about the industry in Islamic finance. But before I do that, I do want to pay a huge tribute to our government in the United Kingdom, which has created a framework for Islamic finance by positioning Britain as the gateway to the Islamic finance industry. And this was done by Gordon Brown when he was the Chancellor, then as Prime Minister, and our current Prime Minister is doing the same thing. The World Islamic Economic Forum, which is the equivalent to the Davos World Economic Forum, is for the first time meeting outside the Islamic world. And it is meeting in London, end of this month. So we will have heads of states, heads of government from all across the Islamic world coming to our country. And what does it mean for our country in Britain? It means that we can attract capital to our real economy investment from the Islamic world. It means that our exporters, when they go out with the help of the Export Credit Guarantee Corporation, they can provide Islamic Sharia compliant financing. It also means that the 2.5 million Muslims can get their home financing and their car financing and be more British and more Muslim at the same time. So Islamic finance is relevant in our country and globally. But before I talk about Islamic finance, let me talk about the concept of Islamic finance. So Islamic finance is first and foremost about community banking. It is serving communities, not markets. If you look at banking globally, 90% of banking is actually local banking. Only 10% of it is international banking. So Islamic finance is about community banking. Secondly, it is about ethical investments. It's about putting money into the real economy, into the value producing economy, into assets which are productive assets. And the Quran describes it as that which is good for mankind. The Arabic word is yanfaun nas. So you put money as trustees, as vice regents, the wealth which we own, we hold it as trustees and we have to put it for productive usage, which means that Islamic investors cannot put money into derivatives which have been called as weapons of mass destruction by some people. So it is really about that aspect of Islamic finance. It's also about corporate social responsibility. And it is a continuation of the Abrahamic traditions, of the Abrahamic faiths that Islam continues. And there is a very good piece of work which has been done by an economist who did his PhD from Oxford University. And that work was called Interest in the Monotheistic Scriptures and its Impact on Modern Financial Systems. This was done in the 80s, for which Dr. Paul Mills was awarded a PhD. And he talked about the role of ethics, the role of CSR, the role of prohibitions of interest. In the previous older books, the Old Testament, the New Testament, and Quran being a last testament, as we say, as the last book, and Islam being a later day religion, has a certain definitiveness about it, the prohibitions on interest and the ethical guidelines. But this is a continuation of that Abrahamic tradition, of the Abrahamic faiths. And this is very important to understand, that there is an alignment. And of course, our CSR tradition in the Islamic world are based on the Quran and also the teachings of the Prophet. So based on those CSR guidelines, the Muslims created 1,400 years ago trusts for the environment, the trust for animals which had lost productive usage, such as horses when they became old, or cows or buffaloes when they could graze in parks, trust for places of worship, for churches and synagogues. So this is how the heritage of Islam was. And this is summed up in a very good book called Our Civilization, the Islamic Civilization, by a scholar called Dr. Mustafa Sibai, Sibai. And he, in his book, talks about the heritage. So Islamic finance is about that kind of corporate social responsibility which extends to everything. So therefore, Islamic investors cannot put money into defense or armaments or anything which is not good for mankind. The other thing is that it is based on a concept which is derived from the Quran called Marifa, which means exchange of knowledge, ta'aruf. So to exchange knowledge means that you take knowledge from those who have more knowledge than you, and then you also pass on knowledge. This whole concept of Marifa is very important because in the Quran God says that I have made human fraternity into tribes and nations so that they could do Marifa. Marifa means so they could get to know each other. So an investor from the Middle East created a fund called Marifa Fund, which is exchange of knowledge. And he went to the universities in UK Imperial College, Durham University, Cambridge, lots of top universities. And he said, I am an Islamic investor. I want to put money to work so that I can improve the quality of life. And how would I make this investment? I will give this money to the university. The university will manage the science and research part of it. Whatever research produces patents, those patents will be owned by this fund. And the fund would then go out and commercialize it. Whatever is commercialized will be shared in a profit sharing basis between the university, the scientist, and the investor. So guess what happened? Scientists were suddenly going back to their homes and looking in the attic for a paper which they wrote when they were in their undergrad or postgrad, and they started developing this. This kind of a partnership, the sharing of risk and reward, is based on two Islamic concepts. One is called mudaraba, which is a partnership agreement. It's like an asset management agreement where you share the ratio of profit sharing, but you don't decide fixed rate returns. So the university does not have a fixed rate cost. The scientist does not have a fixed rate cost, but the scientist in this case became the mudarib, the man who was managing the whole process, and for that he had a return. The investor was getting his return. I share this example just to give you a sense, and I will get into greater detail about this. This contract called the Mudaraba contract was at the heart of the Islamic finance industry. And I will also talk about personalities who were involved in the history of Islamic finance. So, the Mudaraba contract.
So is that a contract that involves, it's a loan, but it's a profit sharing loan? Is that what it is?
So what it is, it's a trust contract. It's like an asset management contract. So let's say, David, that my colleague Husley is very good in real estate investments. And you give him money, and you say, Husley, here is £100,000. Go deploy it in real estate investment opportunities. There's a student accommodation, is a great opportunity. It will have a rental income. You and Husley, he as Mudarib, and you as Rabbul Mal, which is the owner of the fund, enter into a contract where you decide your profit sharing. But there is no predetermined return or guaranteed return to you as an investor. Therefore, the due diligence which you would do on him would be huge because you are trusting him with your money.
What happens if things go really wrong? Do I have unlimited liability like in a partnership? Or do I just lose the money that I lent?
Well, so there is different kinds of mudarabas. There is a restricted mudarabas, which is you can say to him, look, the money will be held with my bank as a custodian. You can only buy this property and use the money for buying the property. So the more tight covenants you have, the liabilities will be less on you as an investor. So this mudaraba contract is at the heart of Islamic finance. What does it say is this money should be put for productive usage, and it should not circulate amongst those who are wealthy. So people with enterprise and ideas can come and share the money without having the burden of a fixed cost. This concept, Mudaraba concept, and the Mudaraba contract was first brought into Islamic finance in the early part of Islamic finance, in its modern shape and form, by a scholar from Egypt called Sheikh Khatir Muhammad al-Khatir. He was the Mufti, or the grand leader of the Islamic thought. He was of Greater Egypt, when Egypt and Sudan used to be one. He was a remarkable man, and I've had the opportunity to be under his tutelage. At the age of 85, 86, he could tell you chapter, verse on jurisprudence book. He had a photographic memory. He wrote this Mudaraba contract, which is at the heart of the Islamic finance industry. The next point is that Islamic finance is also about fairness and justice. Now, justice is very, very important. It's a core pillar of the Quran and the Sunnah, and in fact, it is the guiding principle. Eliminating uncertainty, which is called gharar, and justice, which is adl, is very, very important in the basic principles of Islamic finance. But as much as it is important to understand the basic principles of Islamic finance, I'd also like to talk to you about the context of the time and the place when Islamic finance started. So, firstly, it was a movement which was started by educated, enlightened Muslim middle class coming out of colonialism, and it had the leadership was given by Sharia scholars. So, out of Saudi Arabia, we had Sheikh bin Baz, a cleric who the current King Abdullah regarded him as his teacher. He was blind, and he was a man who passionately believed in justice and believed that the role of finance is to distribute wealth through the private sector, not through public sector, through the socialist model. So in many ways, the foundation of Islamic finance was capitalism with a moral perspective. The state has to be the referee and the umpire, but the private sector has to work under the state. And justice was a corner pillar, and Sheikh bin Baz was very, very instrumental among the Sharia scholars. Sheikh Khatir, the Grand Mufti of Egypt, with this great photographic memory. Sheikh Taqiyuddin Usmani, one of the leading scholars out of Pakistan, who has written many, many books, was a judge in Pakistan, and he was the Chief Justice as well. And when you go to Pakistan, and I had the opportunity to be an expert witness in a court case, and when the judges come in and they tell you all rise, and they sit on a big platform, and when you are standing there as expert witness in front of those judges, so Sheikh Taqi, there was a case on interest, prohibition of interest in the Supreme Court of Pakistan. So we have a judge from the Supreme Court. So we have all these scholars who laid the foundation from a Sharia perspective of Islamic finance. Then we had economists like Dr. Paul Mills doing his work in Cambridge, but we had Dr. Najatullah Siddiqui, Dr. Umar Chapra, many other scholars who laid the foundation for Islamic finance. Of the modern scholars, Dr. Abbas Mira Khor, who has written about 20 books on Islamic finance, is currently teaching in a couple of universities, including Malaysia. But it required businessmen as well to come and take risks. So people like Prince Muhammad Al Faisal Al Saud, the son of King Faisal, Saudi Arabia, urbane, sophisticated, Western educated, yet grounded in his roots. He put his prestige behind the Islamic finance movement. Sheikh Saleh Kamil, who is the founder of Al Baraka Group, he started into Islamic finance because his mother said, if you use the conventional interest-based system, I will not partake from any of your wealth. So her mother's wish was fulfilled, and Sheikh Saleh Kamil then went to all the Saudi banks, and one of the banks said, well, I will do the Mudaraba contract with it. The bank made a huge amount of money because the profit participation, when it works well, it works very well. So all other banks in Saudi started following that. So the early beginnings were really kind of enlightened, educated people wanting to create a responsible model of banking so that they could have an impact on that. People like Royal Professor Unku Aziz, whose daughter is the governor of the Central Bank of Malaysia. He started the Hajj Fund, the Pilgrims Fund out of Malaysia. These were the pioneers who had the vision. And when they started, it was a very difficult time because at that time in the 70s, the macroeconomic framework was not there for Islamic finance. The legal framework was not there, the commercial framework was not there, and more importantly, the regulatory framework was missing. Everything was geared for the conventional banking system. There was nothing which was prepared by Islamic finance. And the rule book for Islamic finance was not even ready, no one thought about it. But the biggest challenge was not that there was no enabling framework. The biggest challenge was the mindset. Most of these countries were coming out of centuries or prolonged period of colonialism, and they had a mindset issue which was a Western mindset. Render unto Caesar what is Caesar's, and render unto God what is God. So the question of bringing religion or ethics or morality derived from religion into banking and finance was an alien idea. How could you do that? And this was the period in which the colonial powers ruled this country on a policy of divide and rule. And Gandhi India's founding father said, for 110 years they ruled us through a policy of divide and rule. And when they were leaving, they had a policy of divide and quit. So it is in this context, at that time, Islamic finance was coming in, and the whole concept of religion and finance, even when Islamic finance started, in the 80s, a major publication ran an article called "The Quran in one hand, the calculator in another. Will the profit rise or fall?" Very skeptical article, saying, what is this business about combining religion and money together? You can either serve God or you can serve mammon. The two shall never meet. But the same publication today is having dedicated books on Islamic finance, is having conferences, is doing lots of work in Islamic finance because the industry has grown significantly. We also did not have an industrial infrastructure in the Islamic world. So 31st August 1957, is there anybody from Malaysia here? All right. So you were obviously not born on 31st August 1957, but I was. 31st August 1957, if your dad and mom went to a shop in Malaysia to buy a nail, or somebody got onto a bus and bought a ticket, that ticket was printed in Her Majesty's stationery shop in United Kingdom. The nail came from Sheffield. We had no industrial infrastructure. In every aspect, the trade flows, raw materials coming from the colonies or former colonies, finished products going the other way around. This is the context in which Islamic finance was starting. Most of the capital markets were closed. There were no capital markets. No wonder most of the newly emerging countries, they adopted state-owned enterprises, socialist models, because it was difficult for them to get out of that mold, the mindset and everything else. The other challenge, which is, David, in your field, was the work on Islamic law. So the last authentic work on Islamic commercial law was the Mujalla al-Hikam al-Adiliya, or the book of the rules of justice, by a great Turkish scholar. Is there anybody from Turkey here? All right. So there was a Turkish scholar called Ahmet Sevdet Pasha. And this book was written between 1869 and 1879. It was the authentic commercial code for the Islamic world. But this book was never updated, never upgraded after 1879. Nobody did the refresher to that. And then what happened? This was discarded, and in countries where France was ruling, there was the Napoleonic Code. Where England was there, the UK civil law came into it. So in the commercial world, for more than a century, the Majalla, Ahkam al-Adiliya, version 1869, was never applied. So you're looking at a time when these markets were closed and the rule book was gathering dust, and there was no... What happened then, that as the countries became independent, as wealth started coming in, people started getting educated. It is the educated urban middle class which said, we must manage our money responsibly because we will be held accountable in front of Almighty God. In many ways, Islamic finance is a consumer to business model, from a business model perspective. It's a C to B business. Generally what happens, you create a business, you go to consumers. In the 70s, there was a huge pent-up demand. When the first Islamic financial institutions were opened and they went, people came to them and said, I've got a 10-story building, I will give it to you for 1 riyal, 1 dirham, to open an Islamic financial institution. Why? Because in Islam, the biggest sin is the sin of usury, of interest. And the Quran has said that God and His Messenger have declared war on interest. So when people got educated, they said, now we got the money, we got to manage it responsibly. And Islamic finance grew and grew beyond the tipping point. And there's a very good book called The Tipping Point, actually, by Malcolm Gladwell, and I don't know how many of you would have read it. It talks about how a concept becomes a trend and then how a trend spreads. So small companies started by a few people, suddenly becomes a big movement. So this is how Islamic finance started. It was because the C2B business. It was not created by a presidential decree or by a royal order. It was created by the consumers. The most important trends in the world are the ones which are led by consumers. And this is at the heart of the growth of Islamic finance. But when Islamic finance came into the market in the 70s, this was a time of huge change. London had its big bang, but something else was happening in America. Senator Glass and Senator Stegall, who after the Great Depression and the crash of the stock market, had passed a law called the Glass-Steagall law, which separated investment banking and commercial banking. That Glass-Steagall wall was being chiseled away. If you went to the offices of Citigroup's former chairman, Sandy Weil, he had a plaque which was bigger than this wall, on which there was a wall called the Glass-Steagall wall, and there was a portrait of Sandy Weil with a hammer saying the destroyer of Glass-Steagall wall. These giant universal banks, they were being created. The process had started. In the 70s, something else happened, which Anne Pettifor would talk about it, because she's very passionate, which is the delinking of the dollar from the gold standards. When Treasury Secretary Dulles went to President Nixon and he said, Mr. President, we don't have money to repay the French. What shall we do? He said, what options do we have? He said, Fort Knox has no gold. So Nixon said, well, we will give them what we call an IOU. And if France doesn't take, what will they do? Will they come and fight us? So he said that, Mr. President, you got to call de Gaulle. So Nixon called de Gaulle. He said, listen, we're going to send you a note. You trust in the United States of America? He said, of course I do. So they gave them the IOU. That IOU, which America gave to France, basically delinked dollar from gold and created what is fiat money today, a printing press. So those of you who are studying economics, you know what is happening to the world economy. We have a whole huge influx of money coming in. So there was a huge revolution going on, deregulation, technological revolution, and what was happening? That the financial economy was slowly becoming bigger and bigger. So, and then it overtook the commercial economy. The commercial economy and financial economy became at par in the mid-70s. In the 80s, financial economy took off and it became much bigger. And then the gap between the financial economy and commercial economy became so large that as a result, we've had many problems. So Islamic finance came at a time when the world's global financial system was changing. Here is a movement which is saying don't put money into derivatives, and derivatives are just taking off. Here is a movement saying no more collateralized debt obligations, and CDOs are just being invented. So what happened was that the commercial economy was at the mercy of the financial economy, and volatility grew hugely. And there was another thing which was happening, that there was an increase in materialism. And I don't know how many of you have seen the movie called Wall Street. Please.
Excuse me, you mentioned derivatives. Could derivatives be used for hedging purposes, not for speculation?
Yeah, so you can, if you have in Islamic finance, if you are a person who is exporting your goods from UK in pounds to Malaysia, therefore you are taking a Malaysian ringgit exposure and UK's exchange rate exposure. To the extent of your trade export receivable, you are allowed to hedge. But if you borrow and say, well, I'm exporting £1 million, but I'm going to take a position 100 million pound or £1 billion because some bank is willing to give me money at almost no cost, that is not allowed. That becomes a speculation. So what you are doing as an exporter from UK to Malaysia is hedging. What somebody else may do when he takes the £1 million exporter and says you should take a position on sterling pound versus the Malaysian ringgit, you are speculating. And that's what hedge funds do. They take two unrelated assets, work out the correlation between them, and take major bets. But
Can I ask a question on that as well?
please.
So speculation on derivatives is not necessarily being connected to usury. It doesn't necessarily involve interest, depending on what you're speculating upon. Is the prohibition upon speculation in financial instruments like derivatives, is that part of the Islamic prohibition on that behavior, or is that a more broader sense of Islamic finance commitment to an ethical approach to financing which rejects speculation?
So one of the things in Sharia is this: you can't sell what you don't own. I can't go and take this gentleman's car and say, David, would you like to buy this car? I can't short sell. So that itself prohibits speculation. And then I can't go and against your export receivable of £1 million, borrow £1 billion and take a position. So derivatives per se came in as hedging instruments. And then when they were misused, it's like any good innovation. It is the usage of the innovation that creates and the context of the innovation. But there was another change which was happening in our society. And I was mentioning the film Wall Street because it covers this aspect of materialism and greed. The fact that greed is good was becoming fashionable. I remember growing up in India, if we heard that a family had mortgaged their house, we would feel so sorry for them. Because you see, to have a mortgage was considered to be a very bad thing. But suddenly the world's value system was changing. And greed became part of the creed of our society, all around us. Consumerism and greed. And it was the Scotsman Adam Smith who said, the father of modern capitalism, greed is good because it keeps the wheel of capitalism moving. But one day, he said, and one day, excessive greed will be the reason for the demise of capitalism. Excessive greed will be the reason for the demise of capitalism. And this was a very profound change taking place in our society. So it is in this context that the pioneers, Prince Muhammad Al-Faisal, Sheikh Saleh Kamil, Sheikh Saeed Luta, the IDB President Dr. Ahmad Muhammad Ali, all these people had to make a choice. Shall we start a new industry without rules, without regulations, no enabling regulation, and hope that these regulations will come? This was the first choice. And when we will have an industry based on 3 Sharia principles. One is the doctrine of necessity, to have an ethical mode of investment is important. Second is local custom and tradition. Third is that, how can we make a choice which enables people to create the building blocks for the future of an industry. So they said there were 2 schools of thought, and the pioneers decided, let's start. So this was a private sector affair, consumers were ready for it, and the movement took off in a very, very big way. But then what they knew, that they were going for what is called a Sharia compliant banking industry, not a Sharia based industry. Because to have Sharia based, you needed to have all those enabling regulations and level playing field. As a result, they had to make certain compromises, and I will talk about them as well. But this was a strategic choice. I believe if we would have waited, we would still be waiting. Because to change rules and regulations in any public sector environment takes longer. Be it a new regulation and changing something which is existing where there is strong vested interest, that takes much, much longer. That decision which the founders took led to the creation of what is today a Sharia compliant banking industry. It is more than 50 countries, and Islamic banks and funds have more than $1.3 trillion, and more businesses are shifting in that direction, and I will talk about the shift as well. So they sacrificed the ideal and they chose the real. So they said, we will start it because the doctrine of necessity, urf, which is local custom, and NIA, which is strategic intent. Based on those three principles, they said, let's start this industry. In the beginning, what they did was they created a series of mudarabas. So they said, we will have asset management contracts in the telecommunication space, in the media space. They had companies which were making watches which could tell the time of prayers, and compasses, all very, very good ideas, food strategy, water strategy. But these mudarabas and musharakas, which is the equity participation, they were done in an environment and in a setting where the rule book was not ready. The test and learn experience of management was not there. And the legal system, most of these countries did not have documentation of case precedent. The legal system was not strong. And as a result, many of these investments did not perform. People lost money. As you were saying, what happens if I give my money when you don't have that experience? So they were not profitable, these musharaka and mudaraba contracts.
Coming back to your mudaraba contract, like you said, under this contract, profit and risk are shared between the owner and the person who actually doing the business. As compared to the conventional industry where some risks are transferred from the owner to perhaps the banking industry, is there a way to reduce the risk of monitoring, reduce the cost of monitoring, reduce the cost of due diligence by the owner of assets or money?
Okay, hold your thought. I'm going to address this when we talk about the strategic framework. And this is a very important question, and I do want to address this. So if I forget, remind me, but it will be addressed as we go along with the presentation. So we started with mudarabas and musharakas, but they didn't work. And when your new industry doesn't make money, what happens? It faces a huge challenge. So what did they say? And this is in the early 80s. So the industry, from an ideal solution, chose to go for Sharia compliant model. But within the Sharia compliant model, they stayed with these two contracts: musharakas, equity partnerships. So you and me can get into a partnership. But because the macroeconomic environment, the test and learn experience, these were closed markets, it didn't work. And no matter who would have come, it would have the same outcome. So as a result, the founders then retracted. They rethought the industry. They said we should focus on another contract called the Murabaha contract, which is the financing contract. So there was a shift from equity to debt type of contracts. The debt contract, the first contract was Murabaha, which is a financing contract. So you buy goods and you sell goods at a deferred price. Cost plus financings. And then there was another contract called the Istisna, which is the work in progress construction finance. So, and then there was another contract called Bay al-Salam contract. The Bay al-Salam was to finance in agricultural goods, oil, and those kind of developmental financing. So the industry shifted in the 80s from equity and asset management contracts, mudarabas, and musharakas to murabahas, with cost plus financing, istisna, construction finance, inventory finance, or Bay al-Salam finance. So it went from equity to financing mode. This was a very important turning point. It took place in the early 80s. Now what was happening in 80s was that the market for financing was quite expensive. Interest rates were high, inflation was a big concern in the US, everywhere else. Suddenly Islamic finance funds started financing on a cost plus financing, and they were building a critical mass and momentum. Now they had to find a niche for themselves because money has to have a proposition behind it. And the proposition which the Islamic finance industry found for itself was based on being a provider of money in a belt of countries which were perceived by conventional Western banks as difficult countries, the emerging market countries, what is called the Organization of Islamic Countries. So they became the providers of financing to Pakistan, to Turkey, to Egypt, to Iran, to many other countries where there were trade flows, commodity finance. And what happens in banking and finance, that proximity to risk gives you a perception of understanding of the risk. The closer you are to the risk, the better you can understand it. The more you understand it, the better you can price it. As a result, the Islamic finance industry suddenly had a niche. They became the providers of finance in a belt of countries called the IDB member countries, 57 Muslim countries. And they were committed suppliers of finance for food products, for industrial products. The industry stayed with the macro guideline, no defense, nothing which is harmful. All those principles were followed in the 80s. But what was not being done was the equity part. Musharakas and mudarabas were shelved, and there was a huge activity of financing. So if you look at the Financial Times in the 80s, they say, secular Turkey finds refuge in Islamic finance. When the Western banks in 94 were shunning secular Turkey, suddenly Islamic finance was the source of cross-border finance. Pakistan importing rice, exporting wheat, industrial goods, Egypt's industrial infrastructure were all being done through financing contracts. And when you looked at the banking league tables, suddenly the Islamic institutions were the biggest providers of cross-border lines in a belt of countries called the IDB member countries. This was a very important development. And another thing which was happening was that the industry itself was getting into a self-regulatory mode. In order to have a dialogue, it created associations. The first association created was the Association of Islamic Banks. But then they created an accounting and auditing organization for Islamic financial institutions, which was interacting with IAS, with BIS. Then they created another body called IFSB, Islamic Financial Services Board, which was interacting with central banks. Now, these self-regulatory industry bodies were entering into a dialogue with established institutions. And this was creating a momentum to give Islamic finance a space on the decision-making panels within those countries. And there was a dialogue going on. And when countries like UK took this decision, it was a big successful decision. Now, when we look at the journey, there was the first fork, ideal or real. Wait for the ideal framework, the founders went, let's start it. There was another fork on the road, and I believe it was a very important fork. When they decided to go into the banking mode and wait for the framework to happen, they had another choice. The choice was, shall we go for an asset management business model or the banking business model? Now, the banking business model was the established model in all across the Islamic world, whether it was the British Bank of the Middle East or the Citicorp or the Standard Chartered or ANZ, they were all banks. So the Islamic banking and finance, Islamic finance would have fitted ideally into an asset management mode. But the founders decided at that time that we will go for the banking mode and we will live with a Sharia compliant form of financing rather than a Sharia based financing, because the public has more confidence in banks. The public has less confidence in asset management institutions. So this, to me, was a very defining choice, because the industry is making choices, and the choices is creating a structure around it, based on which the industry will be making more and more compromises in the future. These compromises today, as I said earlier, has created a $1.3 trillion industry, more than 50 countries, 450 Islamic financial institutions, big providers of cross-border financing, and now there are a number of Islamic Investment Bank and other funds. The IDB, the Islamic Development Bank, which is ably led by the President Dr. Ahmad Muhammad Ali, is a AAA institution. This is the only developmental institution in our part of the world, in the Islamic world, which still has a AAA rating. It's also an institution which has not suffered any reputational risks, any moral hazards, because it has had good leadership and has followed the guidelines of the Sharia. So far, so good. This is where the industry is. I kind of told you the principles, the history, where we have arrived. But we're kind of halfway on the mountain. When we look down, we can see that the industry from a concept has become a movement, and the movement has become a big industry, $1.3 trillion, playing an important role. And today, and there were some important landmarks as we moved along. In the 90s, in the 80s, we had the cross-border financing. In the 90s, equity opened up as an asset class, publicly traded equity. And I mentioned to you the Sharia scholar Sheikh Khatir, Muhammad al-Khatir from Egypt. I had the privilege to take him to various companies. Some of them were the pharmaceutical companies whose drug he was using. I said, Sheikh, we want to buy these companies. He said, it's a very good idea because they make medicines. But I said, to buy these companies, we have challenges because they have got debt, either in the form of cash, so they get interest on their deposits, or they have borrowed money because the banking system, the conventional system is such, the economic system is such that it incentivizes debt. When you have debt as a company or when you have debt as an individual, you can offset it against tax. And it disincentivizes savings and investments. So then the Sharia scholars came up with a guideline. They said if these countries are in the right asset class and if these companies have low debt and low levels of interest and they created certain threshold, then you can buy them. That to me was a landmark event because suddenly equity as an asset class opened up in the 90s. And it is scholars like Sheikh Khatir who managed to open that asset class for us.
Just because you said it is prohibited to take any interest. If you buy a company that is in debt, but you save that company actually, is there a way to make up for it on gaining interest or paying interest, or is it just a no-go and there's no solution to it?
So for publicly listed companies, the current guidelines issue a threshold. So low debt companies with low interest levels have been allowed so that the Islamic finance industry can participate in them. Those equities, companies which are privately held, which you own, there's a different standard for that. But you can finance a company which has debt as long as they are in the right sector.
Okay.
But when you own an equity, all the ownership regulations apply, including so when you get into a situation where the debt levels are higher than the minimum standard which has been approved by the Sharia scholars, then you have to do what is called purify that interest income, i.e. give it to charity.
Okay.
So there is a cost to it.
So you can make up for it.
Yeah, so you give it to charity, you can't make up, it forces you as a portfolio manager to stay with no debt companies or low debt companies, because the moment you go above the threshold, there is a penalty for that.
What is that threshold? What is the low debt?
1/3 of the value. So it's a low beta stock essentially from a conventional portfolio management jargon and terminology. Now, these are exceptional approvals given for the purposes of getting the industry to move forward in an environment which is still very challenging. Now, there was another instrument which was missing, which was the fixed income instrument. So the conventional banks and conventional companies had bonds. So the industry then came up with a sukuk structure. And in the late 1990s, early 2000, there was a issuance of sukuks, which are essentially asset-backed contracts, in which the ownership of the asset as well as the economic returns are shared with the investors. Unlike a bond in which you only share the economic return but not the ownership. So this was again a very big innovation which brought Islamic finance to the next stage of its development and evolution. So what we have today, and the series will cover it, is an industry based on exceptions, given the historical context and given the fact that there is hope of change in these countries. So Malaysia has made a level playing field in terms of regulations. And today it has the most enabling regulations. And this is a journey which different countries are at different stages of the evolution. So as they evolve and as the level playing field is created, more authenticity and better governance is coming into the Islamic finance field. So I was saying that we are kind of halfway on the mountain. When we look down, you see from where the journey started and to where we have come is a long way. When we look up, we see many challenges. And I'm sure future speakers will talk about it. The first big challenge which we have, and this is the challenge of the conventional banking industry and also the challenge of the Islamic finance industry. And the challenge is that why is it that banking is the only industry which is saved year after year, country after country from taxpayers' money? Why is your money used in your countries, wherever you come from, to bail out banks, but not the shipyards, not the clothing manufacturer, not the pharmaceutical industry? All those things can go belly up, but banks cannot. Would anybody like to tell me why? Why do banks have this great privilege? Because banks control something very important. And that is they sit on the jugular of the economy, which is the payment system. If a bank collapses, the payment system collapses. And it will bring the economy to a standstill. It was not like this before. There were clear-cut guidelines on this. But over a period of time, the deregulation has allowed the financial intermediation and the payment system to commingle. So people like Paul Walker, people like former Governor Wayne Angel of the Fed, people like the Vickers report, they are saying we need what is called narrow banking. Narrow banking is there should be two kinds of bank. Safe bank, which keep your money safe. They don't do funny things like toxic assets, derivatives, no front running of clients' money. These banks will control the payment system. Now those banks should be protected from taxpayers' money because they are a utility. They are helping your money, our money to be safe. And then there is financial intermediation through the Mudaraba contract, through asset management contracts, through all those things. And the financial intermediation company institutions do not control payment systems. So if a financial intermediary goes down, why should it be bailed out? It's only a question that it has to be supervised in an effective manner. Please.
In this context, how the rights of interest of investors are protected in this way? Because for normal banks, it is usual that system like assurance of deposits, etc. But in your situation, how the rights are protected?
Well, at the moment, both Islamic and conventional banks are in the same block. They all have to follow the same regulations. What I am advocating, what Paul Walker is saying, what Vickers' report is saying, we should segregate the banking system into what is called narrow banking, two types of banks. Safe banks, the narrow banks, who stay on this straight path, narrow path. They are not too big to audit, too big to fail. They are managed and controlled. And then there are those banks which do financial intermediation. And the bank which do financial intermediation has to have a very strong KYC culture, know your customer culture, have to have very strong compliance, the suitability culture. They have to have a very strong, robust regulatory supervision. And they would then, David, you want to go and do real estate. Sir, you want to go and do trade finance in CIS countries. Somebody else wants to go and invest money into renewable energy. You can all do that through asset management contracts, through partners you find. But if I want to keep my money safe, why should it commingle? This is a fundamental principle. Without this, there is no way that we can have a stability, because sooner or later the financial intermediation function and the payment system collide. And when the control of the payment system is so dispersed that anybody who is in the financial system, and if they go down, the entire payment system collapses. What was the name of the building society which was having difficulties in the UK?
Northern Rock.
Northern Rock. So those of you who saw Northern Rocks, there was a queue of people sitting in the night waiting for their money. So this is a very serious issue. So I think Islamic finance has the same challenge. Unless and until Islamic countries adopt the narrow banking model and bring out an ethically enhanced Glass-Steagall Act which separates commercial banking from investment banking, we will continue to have these problems.
Another question. Have you ever experienced defaults of your banks? I mean, Islamic banks.
Yeah, sure. So, Islamic banks operate in a conventional economy, in a globalized economy. So if you are in a country X, and there is a real estate boom, bankers have this thing called the herd mentality. So everybody follows everybody. And by the time the last bank gets its act together, the markets have moved on. And if the market crashes, then whether you are conventional or Islamic, the values will come down. Now, as an Islamic institution, you cannot over leverage assets. So if you've done a financing up to the value of the asset. So you can't do 100%, 110%, 120%, because you need to have tangible assets. That gives you protection. But that does not give you a total immunity from a systemic risk of a collapse of a market. Now, there is a lot of data which has been looked at. Generally speaking, because Islamic banks don't have derivatives exposure, because they don't have short selling, because they don't do front running in terms of principal trading positions, because they are basically community banks, and community banks generally tend to do better because they know their customers closer. As a result, they have performed better. But have we had the systemic impact of meltdowns impacting Islamic banks? Of course, yes. Does the principles of Islamic finance give us resilience to face these problems? Yes, they do. Because if you don't short sell, if you don't over leverage, if you stay, because this is basically prudent, common sense banking with ethics and morality. It is bound to be better than a system which is based on greed. So that is one systemic challenge. The other challenge which we have is this, that in the last 30 years, capitalism has shifted from what I call from owner's capitalism, we have gone to manager's capitalism. What does it mean? Suddenly, managers are proactively running cooperation. And the owners are being represented by proxies of large pension funds, asset managers, who are not proactively engaged. So in a way, the owners have surrendered their right of ownership to the managers. And this shift from owner's capitalism to manager's capitalism is a major shift in the world. So you can have a CEO of a company getting a bonus of $500 million. So you should say, what is it that he has done that he deserves $500 million? He would say, well, I have created this value in the stock market. Can you see? This is what I have created. The reality is that this whole thing about greed and the shift from owner's capitalism to manager's capitalism has created the problems of Enrons of this world. When you have compensation running amok, when you have governance failing, what does it create? It creates huge problems. Now, this is a challenge for the Islamic finance industry as well. And don't get me wrong, I'm not saying that everybody should be paid the same amount of salary. But owners should not abdicate their right of ownership, and managers cannot and should not take that. This is a very serious challenge. So there are a number of industry challenges, but I want to come back to your question. Can you repeat that? Because I do want to address that.
I mentioned earlier, under the Durable contract, you've got the sharing of profit and risk. So as a result of that, cost of monitoring by the owner would be huge as compared to the conventional system where you shift the risk of due diligence to perhaps the banking industry. So how do you reduce the risk at least?
Yeah, this is a very good point. So what happens in banking, you go to the bank, give your money, forget about it. What they do is their problem. Whether they follow the equator principle. So firstly, from an ethical perspective, most banks do have guidelines, but you have no control over it. Who do they lend? And you get what is called a melded return, which is pre-guaranteed. When you come to an Islamic Mudaraba contract, yes, the due diligence is much more, but as owners of money, we do have a responsibility. And therefore the reward is also higher. Now, different people, somebody may have low risk and therefore low return expectations. So they will have to go and find an asset manager of that kind. Other people may have a high risk appetite and therefore the ability to do high level of due diligence, and therefore their expectation is high return. So that model whereby financial intermediation is done separate from the banks, which are the narrow banks, is a very important solution for the crises which we have faced. Both the financial crisis and the Arab Spring has opened up the doors for Islamic finance, new opportunities, new challenges. Stability is a very important driver for the growth of any economy. So you can't have an economy in a place like Syria today, or banking, because of what is going on. Turmoil is not good for banking and finance. But these countries are now opening up, and there is a hope that there will be stability, because the three things which Islamic finance does is democratizes savings and investments, which is very important value driver for the industry. When you democratize savings, you create a middle class. When you have a middle class, you have hope of stability. And therefore, you can have a government which is based on checks and balances, where there is an open society created, the rule book gets updated and upgraded. The financial crisis has brought and questioned the conventional banking model, and it is being questioned by everyone. And therefore there is a search for the role of morality, the role of ethics, the role of values in finance. And it impacts all of us. It impacts our pensions, it will impact our children. As the world grows, and the Islamic world will have huge challenges. The population of the Islamic world will shrink from a demographic perspective much more than it has ever done. So I'm kind of coming to the end. So we discuss the concepts. Very simple. It's about community banking, ethical investments, corporate social responsibility. It is the continuation of the heritage of the common Abrahamic faiths. It is about putting money into the real value-producing economy in fair contracts. It is removing uncertainty. And then the context, the choices which were made, we talked about it. And we are halfway on the mountain. We look down, we have come a long way. We look up, there are many challenges. And I want to conclude with a quote by Martin Luther King from one of his books called Strength to Love, and in which Martin Luther King says that we, through technology and technological innovation, we have made the world a neighborhood through our technological innovation. Now, through our moral genius, we must make it a brotherhood or a sisterhood. Thank you very much.
Fantastic, Bob. Thank you so much. I put that there to take 5 minutes because we got about 20 minutes, and I know there'll be lots of questions. So I wanted to get some time for that. It's fantastic and interesting talk. Maybe I can kick us off.
Please.
I'll abuse chair's privilege, and then everyone else can jump in. I just want to ask a quick question, and then I'll bring everyone else in. So, as you were talking about the evolution of Islamic finance, as it's grown, as it's become a much bigger industry, you were also clearly describing a lot of the pressures that Islamic finance is facing in terms of becoming a viable industry on the one hand, but on the other hand, sticking to the moral, ethical commitments upon which it is based. And it's particularly interesting as you were talking about the question of whether you could lend to a company that had debt and the adjustment to allow lending to a company with debt, and even a company that was leveraged up to a third of its resources. How does Islamic finance, how has it come to regulate itself? Because those pressures are always there, right? The pressures to, loosen those ethical precepts a little bit in order to make it more viable, to get more business. Those pressures must be there every day of your business. How is that managed within the industry as a whole?
Yeah, so the industry has got a structure, which is every Islamic financial institution has got a Sharia board. Some countries like Malaysia have got centralized Sharia board. There are other countries where there is a combination of the two. So you have your own Sharia board as well as the central Sharia board, like Brunei. So in each of those countries, there is a consensus on 95% of the fatwas. Fatwas are edicts, 6,200 plus edicts given in the last 40, 50 years, which govern Islamic finance, and they cover all kinds of issues. So can you finance a company which has got debt? Yes, you can, as long as the company is in the right sector. Because when you are financing, the relationship is asset-based. It is not ownership. Can you do equity into a company which has got debt? That's where the restrictions come in, the guidelines come in. So out of the 6,200 fatwas or so, there is a consensus of 95%. So nobody can get out of this consensus. The 5% difference is a very good thing because it represents an opportunity to upgrade the industry. It represents a hope for innovation and change and managing change. Because if everybody agreed on everything, we would not be able to regulate it. So that's the first level of regulation. Of course, all the Islamic financial institutions have to comply with the law of the land. Central banking regulations, companies law, Ministry of Finance, Ministry of Commerce directives, as they get changed. And they have to adjust to it. It is easier for be more Sharia authentic for an Islamic asset management company, an Islamic investment company, because they are not bound by the conventional banking regulations. It is harder for the banks. So that is one framework through which Islamic finance industry self-governs itself and is also governed by the laws of the country.
Thank you very much. That was really interesting. I like your metaphor about us being kind of halfway up the mountain. And I think my question is kind of a variation on David's question. So, given your historical description, it seems to me, and I know very little to nothing about Islamic finance, it seems to me that the beginnings you described, it is kind of easier to identify distinctive features of Islamic finance than later on, kind of halfway up the mountain. And I think about situations like the bailout of Dubai World by Abu Dhabi, which to kind of an untrained observer looked very similar to a typical real estate investment trust that's over-leveraged, whose asset values went down and who needed a bailout because, in a way, it was systemically relevant. And so, my question is really, do you think that the pressures David described will lead Islamic finance to replicate non-Islamic finance in more and more aspects, and therefore take away the advantages that Islamic finance has to offer at the moment, and maybe even more so had to offer in the past?
That's a very good question. And so the question is that bailout of a particular real estate company by another deep-pocketed investor. And then Islamic finance, when it started at the bottom of the mountain and halfway on the mountain, what has happened to authenticity? Is that a fair description of it? So that particular example is a good example because the company which was bailed out was not an Islamic company. They had some Islamic financing. And the question is, what happens in a restructuring when you have conventional loans, Islamic financing mixed together? What is the difference? So different structures have different rulings. It is something which is co-mingling of the assets. So Islamic finance has to get a structure where it segregates the asset. Where you have a segregated asset, therefore you have a charge on the asset. But you own the asset because you can't, you are an owner in the asset. Therefore your rights and obligations are different. But the Islamic banks, when they get into a restructuring thing, a committee, and it has happened at the country levels, at company levels, and it will continue to happen. They have to live with the same kind of challenges that the conventional banks have. If they have stayed true to the nature of Islamic finance, they would by definition have been on the safer side, they will have more asset cover. Therefore, the chances of recovery of their financing is much, much higher. Because they would not be as leveraged as their financing would not be as aggressive as the others would be. But on a general note, when the industry, any industry, starts with ideals, it climbs up, it has to make compromises, it has to adjust. Especially because, as I said to you, the regulatory framework, the legal framework was not there. So a round peg in a square, or a square thing in a round peg, eventually has to chisel away. So the Sharia compliant industry is today a compromise to the reality of the economy, the regulatory framework, while keeping to the sectoral guidelines. So all the Islamic banks follow the sectoral guidelines, absolutely. All the Islamic banks, in terms of process and procedures, follow the right things. Where the compromises happens is that when you are doing a financing, sometimes companies have negative pledges, sometimes companies have got restrictions. So they have to find their way around it. And it is in finding the way that things get blurred. And often, I have been through many restructurings and advised on them, where the Islamic investor stayed true to the principles, they were better off. Where the Islamic investments was rooted through an asset management contract, they were better off. Where they came into the banking thing, because when banking things get restructured, generally at the country level or at the creditor level, there's only one pool of assets. Everything comes into a central pot. You have to share the asset base. So those are the challenges which the industry had. But you are right in saying that the industry, Islamic finance industry, has mimicked and replicated conventional products within an Islamic ethos, and this is what we call the Sharia compliant industry. The challenge for the industry is authenticity. How does it become Sharia based? And that can only happen if the macroeconomic infrastructure in the country, the regulatory framework changes to narrow banking. And the role of governments becomes as regulators, referee and umpires, not as players. Government allocate capital to sectors, to venture capital, to SME markets, to infrastructure. And the private sector, i.e. the Mudaraba, the asset management side, are involved in SMEs, in infrastructure, in venture capital, in private equity. That will create a dynamic environment for the growth of ethical Islamic finance in these countries.
Thank you very much for the historical description of Islamic finance development. One thing you mentioned about Malaysia and they have the most enabling regulatory regimes for the Islamic financial industry. And also you mentioned about the history whereby Islamic finance started via consumers, whereby they started their business. They want Islamic finance practice in place. What do you think about the recent initiative by Dubai promoting itself as an international hub or global capital for Islamic finance and economy? Do you
Sure.
think Dubai will really be a very good competitor to Malaysia? Are they going to really play a very good role in developing Islamic finance?
You know, in every industry, there is always a battle for the heart of the industry, the fulcrums. So different financial centers have different strengths. Malaysia has a very deep capital markets. So if you look at the Sukuk market, actually dominates the entire Malaysian capital markets. Malaysia has a very deep stock exchange market. What Dubai has is trade and commerce and a very enabling economic environment. It has a regime where it's easy to do business with, Therefore, Dubai clearly has an edge in the area of commerce, trade flows. Malaysia is still way ahead. Now, I personally believe that, different markets have got their core strengths, and the way the Islamic finance industry is evolving. So we have got different hubs doing different things within the Islamic finance world. For debt capital markets and equity capital markets, Malaysia is clearly in a leadership position because there is depth and there is liquidity in the market and the size is big. Where Dubai would be very successful is in trade and in commerce, in real estate, because it has got a very enabling environment. It's easy to do business with. Our own firm, we're headquartered in Dubai simply because it is a very convenient way to do business from. So I think we need more centers. We just don't need. London itself claims as the gateway to the Islamic finance, and Gordon Brown used to say this, and the current Prime Minister, by hosting the WIEF, and are going to make some announcements at the end of the month, how Britain wants to be a great hub for Islamic finance. The reality is this, that we have got a huge pool of capital, financial capital, which needs to be deployed. And this deployment cannot take place in one market. It will require different hubs to source it and to access it. So Kuala Lumpur is a big center. Dubai is an emerging and a big center as well for trade and commerce. UK has got its own strengths. So I think like any other market, Islamic finance will emerge and there will be different centers for the growth of Islamic finance. The one which I see the greatest potential is Saudi Arabia. Because Saudi Arabia, 26 million population, deep market, depth in the capital market, depth in the financing market, huge pools of liquidity, and the economy is growing. Banks are a leverage play on economy. When banks do well when the economy does well. And at the moment, the Islamic countries, the Middle Eastern countries are doing well because there is a huge boom of liquidity. So that, I hope, answers your question.
We move to the final question. I think that we're going to have to. Iqbal's been going for 90 minutes. I think he deserves a break. So final question. Thank you.
I suppose one of the challenge in finance that we've got all these views, all these Islamic finance boards giving their views. You've got one in Malaysia, you've got one in Dubai, and some say that the scholars in Malaysia, they are too liberal in approving products, and therefore their view is perhaps we should have a single, I would say, Sharia Advisory Council with various representatives from all around the world. What's your view on that?
Well, my view is this, that there's always been an acknowledgement of local customs in Islam. It's called urf and it's part of the tradition of Islam. There is already industry bodies for Sharia. So the Accounting and Auditing Organization of Islamic Financial Institution has a global Sharia board. Then the IFSB, under which also there are Sharia boards. these Sharia boards, they talk to each other. These are the industry Sharia bodies. And as I said earlier, 6,100 fatwas, consensus of 95%. By any standard, that is a tribute to harmonization. And that difference of 5% is very important. It allows us to deal with change, it brings hope for innovation, and it is an opportunity to meet the local customs and demands as well.
Well, it was a wonderful talk. It's incredibly interesting. We could keep talking for 90 minutes.
Thank you very much.